Good morning, good afternoon, everyone. Thank you for joining us today on February episode of ARIVE Partner Spotlight, happening right after President's Day. For those who are new, ARIVE Partner Spotlight is a monthly webinar series that we host in which we invite experts from the mortgage lending community who talk about topics that are relevant in today's market and which can help to grow and scale your business. My name is Harish Tejwani. Along with my colleague, Amy Hulett, will be moderating the session today. Today, I'm really excited to have a truly esteemed panel joining us. Newfi Wholesale, our latest ARIVE partners, and a top originator from one of our non-Dell clients, UMortgage. The panelists will introduce themselves, and they're going to talk about a topic that is near and dear to my heart. How do you say more yes, leveraging non-QM? Non-QM, or alternate lending, is a vital and growing segment of this market that addresses the borrowers that do not qualify for housing finance using traditional agency guidelines. These are sound, solid loans made to qualified borrowers and are completely different from subprime lending of the past. Think of situations like a borrower wants to use their bank statement to qualify since they do not report enough income on their tax returns, or someone trying to use just the cash flow of the subject property to qualify, or someone trying to do a cash out refi before the 6 months of title seasoning is done. You have foreign nationals with ITIN who are looking for housing finance. You have financing for non-warrantable condos. You want to use business funds for reserves. The list goes on and on and on. Newfi Wholesale has been one of the pioneers in the non-QM space. A couple of points that stand out, at least from an ARIVE perspective, and some other interesting things I found out about them. They are the first true non-QM lender on the ARIVE platform. So I want to thank them for their support and partnership. In fact, we had to completely redo our pricing engine in Q4 in order to support the products they bring forward to the mortgage brokers. So our pricing engine got a real nice upgrade because of Newfi. Another interesting fact about them is their products are named after beautiful national parks. Just like these amazing national parks, wide and vast, that grace our country, Newfi Wholesale offers a range of options that can help you navigate through the wide terrain of non-QM. This webinar is meant to be interactive, so if you have any questions, feel free to use the Q&A tab below. We will be looking at those questions and answering them as they come. So before we again get started, I have a quick audience poll. I just want to get a pulse of audience. So there'll be an audience poll running. If you guys can just take a second and respond to that. So everybody should be seeing a poll. So we have just 2 simple questions, which is, are you doing non-QM loans today? Are non-QMs a part of your mix today? And are you guys approved with Newfi Wholesale? So I'll wait for a few seconds as we have responses coming in. All right, so looks like almost everybody has responded. So I'm going to end the poll in 3, 2, 1. So I'm sharing the results. So looks like quite a bit of our audience does use non-QM, which is good. So I think hopefully you can get some new learning, some new nuggets, some new insights about some of the niches we'll talk about. And it is also good to see a lot of you are actually approved with non-QM. So hopefully you will learn more about their product mix. So this was a good survey. With this, I'll hand it over to my colleague, Amy. Amy, do you want to add anything before we start this webinar?
Sure. Thanks, everyone, for joining. I just want to add for our audience that our team at ARIVE is always working with our integrated lenders on additional phases of integration. We've been working with Newfi's team this month in setting up the loan registration process to be available in ARIVE. So we hope to complete that hopefully this week in the next few days, and we'll be able to launch that. So look for news on being able to not only price Newfi, but also electronically register your loan within the Loan Center tab inside of ARIVE. Super excited about that. We also are always working with our lenders on new products that they're launching. As this market always continues to change, new products are needed and desired. So we do have up on deck the closed-end second product that Newfi and a couple of other lenders will be supporting and will be valuable as we continue on in this year. So just wanted to update you all on what we're working on the backside, and excited to have Newfi be such a fantastic partner in all of this and more to come. So with that, we have a lot to cover, many products. We want to go into case studies too of actual loans. So I would love to hand it off to John Wise to introduce yourself and maybe the panel and tell us, why Newfi? What are you guys all about?
Oh, thank you, Amy, Harish. Just always a pleasure to be with you guys and be with the ARIVE community. We've been on the platform now for it's been about 2.5 months, and it's just been an incredible start to a partnership. We're just so thankful for the ARIVE team and expanding their pricing engine to include non-QM. We think that's a good, healthy thing for you, for your community. But really, it's been great for us. We've had hundreds of companies on your network and in your community reach out to us for partnerships. Some that we know, some that we didn't know, and so this has helped us. We also think it will help you as loan officers close more loans, and so we're just really thankful. I think we looked this morning. We have over 5,000 loan officers that we're in regular conversation with, that are part of the ARIVE network. So it's just been an incredible partnership. So thank you for that. I'm EVP of Sales. I run sales for Newfi. I'm not going to introduce these two guys. I'm going to have them do it themselves. You really don't want to hear from me today. You want to hear from these two. Andy Mitchell and Adam West have both joined us today, and really you want their knowledge. They're the ones that are originating loans on a regular basis, and I'm excited to hear from them. So Andy, do you want to just introduce yourself first before I get to Adam?
Of course. Thanks, John. So I'm Andy Mitchell. I've been an AE with Newfi for around 2.5 years now. I come from a mortgage background. I was a loan officer for 9 years, originally from Central Illinois. Moved out to Arizona about 4 years ago in May. Non-QM to me, and I'll kind of get into it a little bit later. Non-QM to me, I had no idea that it even existed before I started working at Newfi. It kind of came. Some people would talk about it every once in a while with deals that that they were offering their clients, and I never really looked into it as a loan officer. I primarily just did BA, FHA, and regular conventional. So I was excited when in my first couple of weeks of just working here, just you start thinking about all the opportunities that you had as a loan officer, how many deals you turned down as a loan officer, and how much potential income you could have had if you would have had these products available to you. So honestly, especially after this call, we're not probably going to go through enough, but definitely reach out if you have any questions, because these products are beneficial to you, whether or not it's now or in the future. Just working with Newfi is such a great opportunity to grow your business. So look forward to talking to you.
Awesome. And by the way, before I get to Adam, Harish, I think I'm going to have to put you on payroll. That was quite the introduction. You got our story down. I appreciate it very much. You did a great job there. This is one of those unique webinars where as loan originators, you actually get to hear from one of your own. And UMortgage has been an incredible partner for Newfi. And Adam's done an incredible job at originating non-QM loans. So I'm really looking forward to hearing from you, Adam. Adam, you want to take everybody kind of through your background and where you're coming from these days? Where are you, by the way, with that big trophy behind you?
The great state of Utah in my basement. I work from home.
There you go. Love it. Love it.
Yeah. Real quick on me. I've been originating for 5 years, been in the mortgage space for about 6. And non-Q, like Andy said, it was never really top of mind. Like I didn't know what DSCR was. I didn't know I just learned how to spell it. Andy helped me with that. And I didn't really know like what bank statements were for like 2 years of my loan journey. You know, like it takes a while to kind of get your feet wet and be able to jump into different products. But the more I spend in the non-QM space, and I think just the more that you are in mortgages, like you're going to get the weird scenarios that come across your desk, whether it's a fallout from conventional or you just learn more about the different loan programs out there. It truly does help the origination. And if anything, like even if you're not closing as much as someone might be on the non-Q space, just having the knowledge and having someone like Newfi in your back, in your corner, it truly just helps you become a more knowledgeable LO and close more deals, because that's what we want to do. We want to close more deals and make more money. So if there is a way for you to do that, I think that having an idea of what non-Q can do for you is a very, very big piece of your growth.
Yeah. No, for sure. Yeah, you know, the thing that's crazy is that, and I love that Adam's on here, is I think you represent a big portion, a big swath of originators around the United States, people that didn't really know non-QM, they didn't really spend any time with it, they didn't want to, they were too busy doing refis, their business was going fine, and then all of a sudden it wasn't, and you have to open up your mind, and so I'm thankful that you're on. But if you look at Newfi, and I'm just going to spend just 2 minutes on this, and then we're going to get into transactions and some of our loan products that we think can help you close more loans. And by the way, that's the only reason we exist, to help you close more loans. That's why we're here. But if you look at Newfi is really structured as a company that's at all levels, from a capital standpoint, from a process standpoint, from a product standpoint. We are trying to figure out a way to help you close more loans and say yes to more borrowers. And that's really been the key, because like I said, so often loan officers just turned non-QM borrowers away. They moved on to another transaction. Maybe they referred it to somebody else and they lost that revenue. They lost the referral source. And now today, what we're finding is more loan officers are starting to say yes to non-QM. And so it's our responsibility to try and figure out ways to say yes to you. And I think there's a couple different ways that we do it. Obviously, some of the things that are most important for you as originators is that we keep our eye on price. Price is always important for you. You know, one of the things that's interesting about non-QM these days is more borrowers know their non-QM borrowers. They already know this. They're coming to you saying, hey, do you have a DSCR loan? Do you have a bank statement loan? They're coming to you with some of these scenarios themselves. So they know a lot of these borrowers are highly educated. And as a result of that, you got to stay competitive on price. So it's one of the things that's important to us. We don't think it dictates the business, because I think you get into some of the other things that are important to Newfi. And we'll talk about that a little bit today, but we're certainly looking at price. We've got a really expansive product menu. We talk about bank statements and DSCR, but it's more than just that. It's even within those guidelines, trying to figure out other options other than just a 24-month bank statement or a 12-month bank statement. We have other options that can help you get to say yes to your borrower. And then obviously from a service standpoint, we're super proud. We're NAM's Service Partner of the Year for 2023. We're really proud of that. We started doing some NPS scoring. Our NPS scoring is reflecting world-class service levels, and you know, we're super proud of that. So this is something that's obviously important to you. Loans are closing here in last year. The average close time was 26 days. These are calendar days, not business days. And a third of our business closed in 10 days or less. And you'll see that in some of these examples here that Adam and Andy are going to go through. Obviously, we're super proud to be an integrated ARIVE partner. And you know, one of the things that we talk about a lot, just in terms of Newfi, is our capital partner. So we're owned, 86% of the company is owned by Apollo Global Management. And Apollo's one of the world's largest private equity firms. $650 billion of assets under management. And while that may not mean a lot to you individually, it means a lot to us because it gets us to this last point, which is it gives us the flexibility to figure out ways to say yes to more borrowers. These are good loans to good borrowers. It's one thing that Harish mentioned in the opening statement there. These are not subprime borrowers. The average profile of a non-QM borrower looks almost exactly like an agency borrower. Credit scores in the 720 range, LTVs in the mid 70s, and these borrowers are all paying about the same as agency rates. The only difference is income documentation. It's the only thing that's different about non-QM versus an agency loan. So we, definitely figure out ways to get comfortable here, and we hope today we'll be able to take you through some scenarios where it can open your mind up to some different options. So you want to head to the next slide, I think. This is just kind of a high level of some of the products that we offer that you should be thinking about as it relates to Newfi. But mostly what we say to originators is if you have a transaction that you are not able to get done on the agency side of the business, we want to be in dialogue with you. It doesn't matter what it is. Pick up your phone, have a conversation with your account executive, and the more conversations you have, the better chance you get at learning the product and learning what we can say no to and what we can say yes to. So definitely be in dialogue. But some of the primary products for us, as Amy said, we just launched a closed-end second. We think it's one of the best priced closed-end second mortgages that exists today in the marketplace. So if you've got a client that's going to try and tap equity, we think you should look at that there, and we're excited about that getting live on the ARIVE system here soon. Obviously, the traditional non-QM products are things that you should be thinking about. So any self-employed borrower that doesn't qualify with their tax returns, we should be in conversation with you about a bank statement loan. DSCR is a huge product for us. About 55% of our units, give or take, every month are DSCR units. And then we love the ITIN borrower. And then one of the other things that we're going to talk about today that's a really kind of a unique thing to Newfi is ways to drive payment down. These are some really creative ways on the non-QM space because obviously with rates going up, that means your payments going up, your PITI is going up, and we've got some creative solutions to help drive those payments down, and we're going to talk about that today. So with that in mind, you want to head to the next slide. I'm gonna have Andy spend a little time on this, and I'd love to get Adam's thoughts on this as well. A lot of people go into non-QM and think, oh my gosh, it's so hard to do. This is really not. We're going to spend a little time talking about it today, but Andy, you want to kind of take everybody back through, some of your thoughts on this? I appreciate your history here.
Yeah, so going back to it. So loan officer for about like 9 years. I think that number goes up about every time I tell the story. It's like the size of the fish in the lake. When I first became a loan officer, I worked for a big bank. There was no non-QM options. It was basically conventional loans, rural development, VA, and FHA. So primarily just focused on that. I was a rate term loan officer for the first year and a half of my career. Then I went to a mortgage banker, then I went to a small bank, and then I ended up working for a mortgage lender that did correspondence, and they also brokered out a couple loans. And I was walking around the office right outside Chicago, walking outside the office, pulling flyers to take back to the office in Central Illinois. And I saw one flyer that said bank statement loans. And I was like, I went to my manager and said, hey, what's this bank statement loan thing? He goes, oh, don't worry about that. Those loans are too difficult. So fast forward, turned down this loan, that loan for self-employed borrowers, turned down this loan. The first company I worked for here in Arizona, I was kind of interviewing, but it was kind of in the late stages. And someone came in and goes, oh God, I got another jumbo loan I got to submit. And I was like, oh, that sounds like a really nice problem to have. But he goes, yeah, I hate doing jumbo loans. So going into the non-QM jumbo loan products that Newfi offers, I was always under the impression that loans were too difficult. And when you come in with that mindset, I mean, it's the most surprising thing in the world is when you close one of those loans in just a few weeks and you think to yourself, well, I was told these loans were too difficult. Well, maybe it's because the partner that they had to submit those loans through was difficult. And I always just remember that. Then you start thinking about like when you're closing loans with some of these loan officers that have ever done non-QM. The first thing they do is, we'll be clear to close, we'll be funded. I'll have a conversation with them like, hey, that wasn't so bad, was it? They're like, I thought non-QM loans were supposed to be difficult. And really what it comes down to is just having the right partners in mind that you're working with. Newfi is great. I mean, we get a lot of fallout from other lenders as well. And a lot of them are turned down business from, I have to have the loan officer sometimes repeat the reason why it was turned down, because I'm just kind of surprised. In John's background, I picked his brain a couple times and been like, hey, in your former company, did they do this, they do that? We'll kind of go back and forth, just because it just doesn't make any sense why the loan was turned down. And you have business like that and those issues, it does put a bad taste in your mouth when it comes to non-QM. I think the other thing too, just to kind of go back to what John said, these loans are not subprime. So I think there is a misconception when it comes to non-QM stuff that they are subprime. So a lot of times we'll get phone calls from loan officers like, I've got this borrower, they have 3% down, they've got a 425 credit score. Can you do anything for them? And that's I think the interpretation when it comes to non-QM is that we'll do loans like that. And like John said, these are well qualified borrowers. And the thing I love about non-QM too is business owners that are self-employed, they know other business owners. So it creates this whole funnel of referrals. If you can close one of them for one borrower, they're going to say, hey, Adam West just closed this loan with, for me, you should go talk to him. And it creates this whole, because like self-employed borrowers are all involved in networking groups. Investors are involved in investor groups. You've got really what it does is it opens up a whole new layer of referral partners. I mean, you can go to those financial advisors. You can say, hey, do you have any borrowers that are looking to invest in or looking to purchase new properties? And they'll say, yes, I got this. It just opens up a whole new idea like that you can of referral partners. So I always thought it was funny because like that was the first thing I ever did when I first came in here. I was just like, oh, these loans are going to be terrible because I was always told they were too difficult. And it's I think one of the reasons why I invited Adam on here is that I think him and I have a similar background in that we thought that at one point in our career. Adam's funny because he always starts every conversation off with, I hate non-QM. I think he told me that one time when we had a CTC in like 2 weeks. I hate non-QM. And I was like, no, you love non-QM. And then, the processors and the closers are involved in that email thread. And sometimes they're asking me, why does this guy hate non-QM so much? But it's great. I mean, everything about, we want to work with you. We want to figure out ways to get that deal to the finish line. And when we can get those loans closed and not that, your competitors can't, or you couldn't in the past, it just opens up a whole new, funnel of revenue for you. You can go to the slide.
All right, Adam, do you still hate non-QM?
Depends on the day. But my 2 cents on this would be, it is not difficult. It is different. And if you're used to just the cookie cutter stuff, like, yeah, it's a different process for sure. Different way to get them pre-approved, different way to look at how to structure the loan. I lean a lot on Andy and like AEs that know what they're actually doing, because we're going to talk about this soon, but like there are exceptions that are made. Like, hey, here's the guidelines, but with compensating factors, we can look at exceptions. And like, it's just different than what you're used to. But if you can embrace that difference, and if you can just open your mind a little bit and have a little bit of flexibility, which I know is hard for many, then you can, again, like at the end of the day, you make more money. Like if you're an LO listening to this, make more money by doing more non-QM. So yes, I do sometimes hate non-Q, but I love making money. So it balances itself out.
Yeah. You want to get to that, go to the next slide, because I think it brings up this point. And certainly Andy's alluded to this. Adam's mentioned it too. It's really important that you pick the right lender. It's absolutely important. So if you're going to do a non-QM loan with somebody that's focused on agency business, the chances of you getting an agency underwriter or somebody looking at it as an agency loan is going to be higher. That's why we think being non-QM focused has allowed us to grow faster than some of the other companies that aren't. And the other thing that's really important is when all you do is non-QM loans, whether or not you're an AE or you're a company. So if you look at Newfi, this is all we do. It means that you're going to be an expert at non-QM loans. So it allows us the opportunity to say yes to more borrowers that don't meet our guidelines. So if you're outside of our guidelines and we've got history for whatever it is, borrower's credit score doesn't meet the requirements. Maybe they don't have the reserves. Maybe they haven't been in a house long enough. There's all these. Maybe they haven't been self-employed long enough. There's all these things that cause these exceptions. And because this is all we do, because of our capital partner, it gives us the ability to make exceptions on loans that don't meet our guidelines. So it's actually one thing that's really important to point out. Especially if you're using when you kind of go into the ARIVE platform, you have your transaction, it comes up, and if you hit us and it says no, we can't do it, still pick up the phone and call your account executive, because there might be a way to get to yes. I'm sure my guess is that's happened in a couple of these transactions where you look at it on the surface and you say, well, it doesn't meet your guidelines, so I'm moving on to the next lender. Definitely don't do that. Definitely pick up the phone and still call us, because we think we have the ability to figure out a way to get those transactions closed. And that's the other piece of value for people that are focused on the non-QM space. When you have a conversation with somebody like Andy, who looks at non-QM loans all day, all long, he's going to know exactly what he can do and what he can't do. And the ones that are like in the middle, where it's like, I don't know, we have this process internally that allows people to present that transaction to our credit committee right up front, so that you can know right away whether or not that transaction is going to be a yes or a no. You're going to have a really high degree of confidence. And it's one of the things that Andy and the rest of the AEs at Newfi do really well, is trying to get you to either a yes or a quick no. Because sometimes a quick no is better for you. It allows you to kind of move on to either from the borrower or to another lender that maybe have a chance to get it done. And we want to help every way possible. So let's jump into some of these transactions. I think that's the next slide here. So yeah, let's Andy or Adam, you guys. Andy, why don't you take kind of through the high level on this one and what happened, how we got this one done?
Yeah, so one conversation I have with a lot of loan officers is, why would you ever do a non-QM loan full doc? So that's kind of why we put this one first. A lot of it is, why wouldn't they go conventional? Why wouldn't they go jumbo? Why wouldn't they do this? Why wouldn't they do that? This was an example of a loan that Adam and I talked about several times. And actually, when it came back, it was, so I'll get to that. But this was a loan that was a condo in Sedona, Arizona. And the issue is that they were trying to go conventional. They qualified conventionally, but the property had a mandatory lease. Now the mandatory lease was tied to a spa that required that it was kind of a minimal amount. I think the total HOA due was like $305. But because of the mandatory lease term that showed up on the questionnaire, it was turned down by the first lender that Adam was working with. From there, it even went to a different broker, because the different broker claimed that they could do it. And then it came back to us, and we were able to grant the exception on it. So Adam, do you want to talk about how you got that business, and then what kind of the whole scenario behind it?
Yeah, so we were 99% done on conventional. Like, everything was cleared out. We were ready to close. We were, like 10 days away from closing. And then this condo questionnaire comes back, underwriter flags it. Deal is dead. Fannie or Freddie will not take it. There's no way around it. We tried everything we could. And yeah, I mean, just one of those deals where like everyone's yelling at you, screaming at you, like it's my fault that the condo has some janky little lease with Hilton. Anyway, we got in touch with Andy and we figured out, like, okay, look, here's what we have. We know this is a clean deal. It's very, very clean. The only thing is one little thing with the lease. So Andy, like John just said, like Andy takes that in, he gets the entire scenario, gets it up, and he comes back and he's like, dude, I can do this. This is approved. I have an exception granted for you on this loan. Let's rock and roll. So this other broker fumbles it around. Oh, you can't do it. And everyone's now coming back to me like, no way, like you're lying, you can't get this done. So pressure was on. Well, I think I lost a lot of hair on this transaction. Like, the sellers had my cell phone and were like and he was a lawyer. It was one of those, like, holy crap. It was just one of those deals. But I'm like, dude, this is going to close. Like, I promise you, you give us a 3-week extension, we're going to get this thing done. boom, we got it done. Exceptions granted. We transferred the appraisal. Everything was in and easy, and we saved the deal. And then I came in as the hero. Like it didn't die. The first loan didn't die because of me, but I freaking saved it with the help of Newfi and Andy and this exception. So anyway, one of those things where, you know, from zero to hero, but this thing was dead and anywhere else. And it was very exciting to get this one closed.
Hey,
Yeah,
Adam,
I
do you
think
remember where the referral came from? Was it a past customer? Was it, do you remember on this one?
It was a loan officer that lives in California, and she wasn't able to originate in Arizona, so she referred.
Okay. Got it. Okay. Interesting.
yeah, I think when that one funded too, we were told, I don't know if this was ever true, but we were told that it was the first lender finance transaction that had happened in 2.5 years. Because
Right.
it was an area where it was basically cash buyers for 2.5 years. We were the first lender in 2.5 years that was able to close a lender financed transaction on this property.
Sounds like a marketing opportunity to me.
Yeah, I was just gonna say, it sounds like you might be lending on every single
If
condo.
he
in-
wants to.
That HOA is shady. I wouldn't be surprised if they just changed their questionnaire moving forward.
Yeah.
I don't know, but we'll see.
But this is a perfect example of like why we would do a non-QM loan as with it being full doc. They could qualify conventionally. They could qualify. The jumbo loan limit's not there, but they could qualify any in a paper. But because of one small minor issue with the HOA, we're not able to close conventionally. And it was kind of comical how the mandatory lease or whatever that was on the Hilton we really only accounted for like 25 or 50 bucks of the HOA dues. So we kind of took a common sense approach to it, got it cleared. So
yeah. No, it's a great point. Most people think non-QM is DSCR and bank statements, ITIN. They don't think about full doc transactions. One of the other things that we see from time to time that you should keep an eye on as an originator is the jumbo market currently has some dislocation to it. And so there are times where non-QM jumbo products are priced better than prime jumbo products. And so it's definitely something you want to keep an eye on when you're out looking for transactions in the ARIVE system. You should be checking some non-QM pricing on those full doc deals as well to see whether or not there's an opportunity maybe to get a better price. So thanks for this. Let's go to the next slide. All right, Andy, you wanna dig in here? This is kind of goes back to what I was talking to at the beginning. Most people think bank statements and they think 12 or 24. We definitely have that, but you want to take everybody kind of through a high level of some of the different ways that you can get to a yes.
Yeah, for sure. So I joke around with this slide a little bit. One of our sales managers here at Newfi gave us the example of how many different ways can you get on base in baseball. And I think it was like seven different ways, and kind of prefaced that into 7 different ways to qualify. Like you don't always have to get a hit to get on base. So 7 different ways to qualify. On a self-employed borrower, you can either do 12 or 24 months bank statements. So why would you do either one of those? Or why would you choose 12? Or why would you do 20, 24? A lot of it is 24-month bank statements price better, but not every single situation the income's there on 24. So maybe we look at 12 instead of 24. Sometimes borrowers just flat out just don't want to provide 24 months worth of bank statements. So then we just lean more toward doing the 12. 1099 is one of my favorite products just because of how simple it is. If the borrower gets a 1099, a lot of times we can use 90% of the 1099 income, and then we only need 4 months bank statements to support that. I like it because it doesn't take very long to calculate the income on it. And it's just the first question I ask is when someone says I have borrowed that's self-employed, the first question I ask is are they 1099? It just makes the transaction so much smoother. Instead of doing the 12-month bank statement, if they're 1099, we can do that calculation and you get more income out of it. Real estate flipper income. This is kind of a newer income program for us. This is for borrowers that their job as a self-employed borrower is they just flip properties. And how we look at that is we take a look at when they purchase the property, we take a look at the settlement sheet, and then we look at what they sold it for, and we kind of do a calculation based off that. If you have borrowers that do multiple transactions a year, I usually ask the loan officer just to provide me with like a handful of these, and I'll try to get them qualified based off of the handful. And if we need to, we can get additional ones. But we only need the transactions for what we need to qualify for the borrower. Asset depletion. So it's funny on like 8-paper transactions. A lot of times you don't want to add too much to the file that would open up questions. Asset depletion is definitely a transaction where you want to find out everything that they possibly have in regards to assets. We have certain calculations that we do on depending on what the asset is, that we divide that number by 84, and that's your monthly income. So if you have, like, when I was a loan officer, you have people that would, have retirement accounts, they have stocks, bonds, but in their checking and savings account, they have enough money to qualify for their down payment. So that we'd only collect that. We wouldn't throw anything additional in the file because it wasn't needed. On an asset depletion file, it's definitely you ask those questions. Hey, do you have any additional funds, retirement, stocks, bonds, mutual funds? Find out that this is the perfect, and you can use a combination of asset depletion and bank statement. So it's just something something additional. IRA or trust income distribution. This is kind of like a Fannie Mae income calculation. We take, if they're getting trust distributions or IRA distributions, we take that divided by 3 year, 36 months, and that's how we come up with monthly income. And then we do have an option for 2 or 6 months bank statements, but we need a CPA letter to support it. The CPA gross receipt letter just needs to state what line 1 is of their business tax returns. Let's say they're a Schedule C borrower. The CPA just writes down writes down borrower's line 1 of their Schedule C that is filed for the year 2023 is $1 million. And then we just need 2 months of bank statements to support that. And then we just, in the last couple of months, we came out with the P&L product as well. And we only need the 2 months to support the income. So we'll use the income for the gross receipt letter that shows on the gross receipt letter and the CPA P&L statement. But then we just need the 2 months just to support that the income is like accurate depending on what the amount is.
Yeah,
so 7 ways to qualify. It's not every single borrower is the same. It's just a way to, we as the AE will ask additional questions, in regards to the borrower's business, and we'll just try to place them where we can get the most income, get the borrower qualified.
Yeah, one of my favorite programs is our gross receipts program, especially as we kind of head into a new year, because really all then you're getting is a statement from the CPA saying their gross income was X. I filed the returns, the gross income is X, and then you need 2 months of bank statements to support that income. It's really that simple. So it's really kind of an interesting program, because if you think about it as a loan officer, one of the things that you're trained to do when you're looking at full doc loans is you go to the bottom line, you go to the AGI, and you start adding back what you can add back. It's, it's kind of how you're trained. Well, for a bank statement loan for self-employed borrowers, we want to retrain you so that you are looking actually at the top line revenue instead of the bottom line revenue. You start at the top line revenue and you start saying, okay, well, there's enough revenue there that they might qualify for a bank statement transaction. So it definitely is a different way of looking at things.
Yeah, you have to consider too, a lot of times you are going to the CPA anyways to get like a percentage ownership letter. Sometimes with bank statement loans, you're going back and you're getting expense factor letters. So it's when you have that conversation, or the loan offer, the borrower has the conversation with the CPA, maybe just have them throw on the income, and you could throw it on the same letter, hit 2 birds with 1 stone kind of thing. And you're already getting the letter, you might as well have them throw the income on there as well, and then we can only collect in 2 months.
So I also want to have a personal story here. I think I mentioned like this topic is near and dear to my heart. So about 13 years ago, I started my first business. It was a new business. Like in a few years, a couple of years, I had, better income situation. And few years in, as a self-employed borrower, I decided to buy a house and try to get financing. I truly wish, all these great options were available at that time. I was arguing with the loan officer at the time, why do you have to factor 2-year income documentation? My income is growing. Why do you have to do the average? Can't you just take my last year's income? So I truly, truly wish, all these great options were available 12, 13 years ago. But these are great, options for self-employed borrowers. They are like 6-7% of the overall market and growing rapidly.
Absolutely.
All right.
All right, we got another loan from Adam. I think this is no, this is just a summary. Andy, why don't you take us through this?
Yeah. So DSCR loans, DSCR stands for debt service coverage ratio. The idea behind it, they're no income, no employment loans. We're using the cash flow of the property, of an investment property to qualify borrowers. So example is if the borrower's monthly payment is $900, but the rent schedule is $1,000, they would debt cover, because the rent for the property is then more than what the monthly payment is. An amazing loan. The thing I love about this program is you can have a borrower that owns 50 properties, and as a loan officer, if a borrower, now we can get into the conventional loan guidelines, but let's say they own 50 properties. Can you imagine on an application writing every single REO for that borrower on an application? I think you would need like 25 applications. So the nice thing about this property is the REO that you would list there on the application is the borrower's primary. If the borrower is refinancing an investment property, you would put the primary in the investment property. No additional REOs, no additional reserves for each of the REOs that are owned. The idea behind it is you got borrowers that want to invest in properties to because I mean real estate is an asset for people. So you invest in real estate. So we have two different products available now. You've got an over one DSCR, which basically means the rent is more than monthly payment, and we do have a 0.8 to 0.99 DSCR program. How you figure out the DSCR is you take the monthly payment divided by the rent, and then that's how you would calculate the number. We do allow gift funds. We do require a 10% borrower contribution. Definitely ask your AE because each situation is different. We go up to 80% LTV. We will allow short-term rentals and long-term rentals. Short-term rentals is if, let's say, you're doing a purchase, we can pull up the AirDNA and figure out all the stats on that property. Long-term rentals, we would order a 1007 or on a 1025 if it's a multifamily, and then the appraiser would basically give us the long-term rental numbers. We do allow foreign nationals. Definitely ask your AE for more information in regards to the foreign national program because it's a little complex. But the short-term rental, we'll also do short-term rentals on refis as well. We usually just need a 12-month host report. I love this program because especially with realtors, if you're marketing to realtors, a lot of realtors own investment properties, and realtors also know investors because they're showing their houses. Great referral program. I just think it's great. Like as a former loan officer, this is definitely a program that I would hit in regards to referral partners, hit realtors, financial advisors, CPAs, tax preparers, because they would have a great idea of which of their clients would be interested in a product like this.
All right. So next slide.
Yeah. So this is a scenario that Adam and I had, Lake Havasu, Arizona. The situation behind it is actually funny. It was a program it was a loan that I talked about with Adam probably the first time I talked to him about it. Then I think it came back like 2 months later because the borrower got denied conventional financing. I don't remember the entire situation, but it was a property in Lake Havasu, $750,000 loan amount. The DSCR ratio was over 1, 80% LTV, great credit, 3-year prepayment penalty. This was a short-term rental transaction. So the long-term rents came back on it. I believe it was a condo. The long-term rents came back on it. They weren't great. And I think it got flipped to us because we allowed that. We were one of the few lenders at that point that allowed short-term rental calculations. And the short-term rental calculation basically got it to debt cover. Adam, do you want to talk about this one at all?
Yeah, I think for any LO listening, this is huge. Like DSCR for the most part is on a long-term rent. If 1007 comes in, whatever the heck that is, you're taking 75% of that, does it cash flow at the 1-to-1 ratio. But if you are in an area that allows for that has, it can't just be like middle of nowhere. It's got to be somewhere that actually has short-term rents as a commonplace. If you have an investor buying a property there, like, you should absolutely look at this. Like Andy said, if you go DSCR, it's so flippin' easy to get the loan started and get it submitted. Usually, this is only investors. Typically, it's investors that have bought more than one property before, more than one investment property before. So, making this easy on them is something they're very interested in. But yeah, I mean, that we got this loan closed because we looked at short-term rents in Lake Havasu, Arizona, and we passed our ratios because we were able to look at short-term instead of long-term. So this is something like you can pick up the phone, call your realtors and say, hey, this is actually really cool. If you have any market that allows for short-term, do this. Call your realtor, say, what's up? I have an awesome new program. It's short-term rents on an investment-only property. You should talk to any of your investors about this property. Boom. You just created value to your realtor, taught them about something they've never heard before, and you have something else to go sell.
Love it.
Absolutely.
Absolutely love it. Hey, Andy, do you remember the two exceptions that were made on this one?
Yeah, I believe it was going to 80% LTV. I believe the guideline for short-term rentals, they need to be at 75% LTV, and we were able to go up to 80. The second one, I'm not 100% sure. I think, actually, you know what? I think it was because Lake Havasu, because it's seasonal. Arizona, everyone always thinks it's the desert. But I think Lake Havasu, the market is slower during the winter months because it's kind of a party central during the summer. We were able to, because the numbers for short-term rental weren't the market or the occupancy score wasn't great. We were able to get go up to 80% and allow for because it's a seasonal property, allow to use the short-term rentals.
Yeah, and just to point out again, it kind of goes back to the ease of use issue. Is this thing closed in 16 days, business days? This is the 16 business days. So these are easy loans to close. Adam, do you remember, again, kind of going back to the borrower? I think this is an important conversation just to kind of think about where the borrower came from. Was it a past customer? Was it a referral? Do you remember?
This guy fell out of the sky. I don't know. He found my number online somewhere. No idea.
Yeah, there you go.
You
Right,
found
but
out
you
that,
didn't. But you
Adam-
didn't turn him away.
He
No,
found
we
out
took
that Adam
away.
was an Airbnb superhost.
Oh yeah. That's a big flex that I always do. I am a super host, so I know all we can know about short-term rents, right, Andy?
Yep.
Nice.
And
Good.
Andy, Newfi is one of the few lenders or very few lenders that goes below a DSCR ratio of 1. Have you seen situations where the cash flow was not sufficient, but still you got the deal done? Is there anything that comes to mind?
A lot of it depends on the area. So, I mean, and also you have to think too, appraisers don't have access to a lot of, I would say, comps for rental properties. You have to kind of think like when appraisers are doing, value comps, they come up with, they go to the MLS and they pop up and it says, recent sales in the last 6 months, and then boom, you got a comp. But rentals are a little tougher because they're not always public record. Like, if John was renting to Adam, and it was just a private landlord, the appraiser doesn't have access to that information. They don't have access to the property that could be possibly next door and those rental numbers. So we try to do everything we can. I mean, unfortunately, with these DSCR loans, a lot of times when the appraisal does come in, we are having to sort of restructure. I mean, we got so many different options to restructure, whether or not that's lowering the loan amount a little bit, lowering the rate. We could possibly go to interest only. I mean, there's a lot of different options to do that. But in the past couple of months, we did come out with that 0.80 to 0.99 program. And I will say it's not, the AE or the LO isn't going into the transaction pitching that product. It's usually just a fallback because the rent numbers came in too low. And it's like we tried everything we could, and it's just I think at one point, I mean, John had the stats one time on a sales call that we could have, before we had this product available, a certain amount of percentage we had fallout because of the rent schedules. So it's us coming out with this product, the 0.80, just allowed us to 0.80 to 0.99 as well. just allowed us to save a lot of deals for the LO. And then a lot of times too, you have to think like, you know, maybe they switch the 0.80 to 0.99 product and they do like a 1-year prepay, and then they get some tenants in there, and then they decide, you know, rates go down or, you know, whatever happens, they decide to then, you know, they have tenants in there. Let's say that, you know, the market's changing for rents, they could potentially refi in the next year or so. So then you get two loans out of it. Provide those leases, and then we have, you know, a property that's actually cash flowing at that point. So it's kind of just a fallback just to save loans more than anything else. But pricing's great on them. I mean, it's not too much different than our over one product. There's a little bit of a hit to the pricing, but it just allows you to, I mean, it's such a relief on the AE side when we have these appraisals come in low, just to have that fallback, just to be able to get us to a point where we can get them approved and closed.
Yeah, Harish, I think what we find too is that there, you know, sometimes people buy investment property for reasons other than cash flow. Sometimes people believe that the value is going to go up. Sometimes they think rental rates are going to go up. Sometimes, you know, there's all sorts of reasons why people buy real estate investment properties, and it's not always because they cash flow. So this just gives you an option that we think helps get you to a yes.
Yep, and Andy kind of hit it on the head. You know, the comps of rentals for private party transactions are not public record, you know,
Right.
and you guys have
Right.
this option where this fallback is available if 1007 comes in low. So that's wonderful. All right,
Yep.
so I'm on the next slide.
Yep. Andy, you want to go
Yep.
through this?
So about a year or so ago, we came out with an ITIN program. I'll circle back to the story I had about the you know, non-QM loans being too difficult. I had no idea what an ITIN was. We came out with this program, and I just sat there with my pen and paper while we were going through everything. I didn't even know what ITIN meant. So really, it's a borrower that instead of having a social security number, they have an ITIN number. Up to 80% LTV, full doc or bank statements. So we're probably one of the few lenders that does a bank statement loan on an ITIN borrower. We'll do it the exact same way as we would on our regular product. Send me the bank statements, I'll calculate the income, and then just move forward with it. We do need 2 scores. So we do have a lot of our programs. I wouldn't necessarily say they have trade line requirements. They have credit score requirements, but this product does have a little bit of a trade line requirement. So what I ask, and then a lot of the AEs ask for, is when you send, let's say it's a self-employed borrower, send me the bank statements and send me the borrower's credit report, and then I'll look at both of them and I'll see whether or not we're eligible for anything. Because we do have some trade line requirements for that, and then we can do them on owner occupied and non-owners, and then it kind of goes into the trade line requirements. So the one thing too is we do use housing history as one of the trade lines, so VOR. Verification of mortgage if for some reason the mortgage doesn't show up on the credit report. It's definitely this loan program has been definitely a learning experience, but I think the first couple ones that we closed, it's an awesome product for people that just have an ITIN number. And you run credit just the same way as you would a social security number. You run that as an ITIN number. So yeah, it's a great product, and it's an untapped market for sure, because a lot of LOs that I talk to they're always saying, "Oh my gosh, you guys got an ITIN program." I have realtors asking about this program all the time. So it's a great option for people.
These are great. These are great loans. We love them.
I'm on next slide already.
All right.
Yeah. So
go ahead, Andy.
As I say, so we just released a couple months ago a new closed-end second mortgage. This is not a HELOC. I know people ask that again. We have a jar in the office every time someone says HELOC when they're trying to pitch these products, but it's definitely a closed-end second mortgage. Loan amounts anywhere between $75,000 and $350,000. Max CLTV is 85%. Minimum credit score is 660. You can do them as a rate term and cash out. Rate term is kind of uncommon. It's more like, you know, you're refinancing a second that was used for on a purchase. Cash out is the most common one. We can't do them at this moment in was it Minnesota, Massachusetts?
Yep.
Owner occupied purchases only. We do 10, 15, 20, 30-year fixed options. Some loans do not require an appraisal. We do have an automated valuations system that we can run if the loan amounts are under 250. Texas, we do allow this product in Texas, but Texas, you got to be really careful. And you do need a full appraisal in Texas. Priced super well. If you think back, like I priced one, I think when this product first came out, I priced one at like 8.25. And I checked my system about 5 different times thinking if the system's broken. I reached out to my lock desk and was like, hey, I think our system's broken, because this was like that was like a bank statement loan like a month ago, on a first lien. So it was like, we're offering this rate. And then I think too, it's really, the difference between a closed end second and a HELOC is pretty simple. It's either you get all the funds at closing or you don't. It's really just having a conversation with your borrower. Does the borrower have a set dollar amount that they need? Are they doing renovations on the property? Are they buying potential investment property? I had someone one day I was talking to that was using this loan only to use for a down payment on their DSCR loan. So it was like, we're hitting them, we're doing that loan for them, and then we're also doing the DSCR loan for them. So if the borrower has a set dollar amount that they need to finance, awesome product. It's a fixed rate for, up to 30 years. HELOCs, they sometimes that rate moves around a little bit depending on what the prime rate's doing, but it's a great product for people, and it's just another option to have in your back pocket. The one thing I will say too about this program is called the Olympic program. You can make full comp on it if you're the loan officer. So a lot of times, home equity loans, you're having to kind of take a reduced comp or a set dollar amount depending on it's like a set comp. You can take a full comp on this product, and that's what's appealing to loan officers.
Yep. Now we think this product here, this is our fastest growing product without a doubt, and the reason it's our fastest growing product is because it's giving loan officers the ability to go back to their database full of agency 3% rate borrowers that they can't touch. They know they're not gonna mess with that first lien. It gives them the opportunity to go back and sell them the ability to access the equity that they have in their house. You guys all know this. Equity levels in the United States have gone off the charts. There's a massive amount of equity that exists in the housing market today. So this gives you the ability to go back and have a discussion with the people that really it's not possible. They're not moving from that 3% mortgage. This gets you into dialogue with those borrowers again. And as we know, you never know where those conversations lead to. Maybe it leads to another transaction. Maybe it leads to a referral. Maybe it leads to a second lien product. And one of the reasons there's a lot of seconds that are out there in the market today. Some of them higher rate, some of them a little bit more expansive guidelines. We think this is perfect for your agency borrower. Because you've got a CRM that's full of these borrowers. If you've been in the business since March of 2020, you've got a database full of agency borrowers that don't want to move from that low rate first. And this, again, like I said, this gives you the ability to go back and be in discussion with them about a potential transaction. So good stuff. All right. So one of the last things, matter of fact, can we go? Because I think Adam, you use this. Can we go to the next slide? Because go to the next one. So this is an actual example of a deal that Adam closed, where he used our ability to do a 2-1 buy down to lower the payment for the borrower. So, Adam, you want to take us through kind of how you got to the 2-1 buy down, like how that came up?
Yeah, the one exception made is we had a late payment on a mortgage, and the buyer had no idea. It was ultimately like pretty clean, except she just missed a late payment on this she had a land loan, missed a payment on it. Anyway, we took her into non-Q, and she was very afraid that what happened to her rate, which, as you can imagine, a late payment and a lower credit score, her rate went higher. When you take it on Q, rates go higher. So we said, hey, look, if you still want to buy this house, let's get some seller concessions, and we'll do a 2-1 buy down. So instead of that scary high rate, we got 2 years to kind of ease into this. And hopefully by that time, we're going to be able to refinance out of that high rate, get you into a lower rate after your late payment falls off. And yeah, buyer was stoked. It was perfect. It was one of the easiest ones, and lovely loan amount. Isn't that just great?
And you guys close this in 12 business days. Look at that. 2-1 buy down with a 1099 borrower. Think of closing that in 12 days. That's so awesome to see.
Andy, anything to add on this one?
No, I mean, it was a super easy transaction. Yeah, just that one exception that was made, and then Yep. So I mean, it's super easy loan. I mean, I remember being an LO and closing a loan in 12 business days on a conventional loan was a huge success story. So let alone a non-QM loan, it was just great.
Yeah. Solving problems. That's what we do here. Solving problems. And like, that's what your job is as the loan officer, to solve problems, to get that borrower from where they are to where they want to be. And this borrower ended up with a piece of the American dream because of the work that Adam did to help solve that problem. So it's a beautiful thing.
Yeah. And I will say too, I think this transaction started off with, Adam wanted to do a bank statement loan. And we ended up, first question I asked was, is the borrower 1099? All of a sudden, they're 1099. He already had the 1099 income, and we just did the income in about like 5 seconds. And I was like, oh, here's the income to use. Just send me a couple months worth of bank statements to support it. And yeah, it was a super easy transaction.
Hey, Amy and Harish, I know we're running a little tight on time.
Right. So you want to talk about anything specific? We are a little over time, and maybe Amy, are there any questions you want to put to the guests today, if you see any?
I mean, there's a couple of questions I think we can address offline. One of the questions is, when you refer to a CPA verifying something, can a tax preparer ever do that? Is that acceptable at all?
Yeah. CPA or licensed tax preparer is what we allow.
Okay, cool. And then do you offer multi-units for ITIN borrowers?
Yep. Yeah, you can do up to 4 units.
Okay, so yes, the answer is yes, everybody. You just got to call.
Yeah.
That was the name of this whole session is yes, right? So far everything is yes. I mean, I know we're gonna talk about this. What I feel like I'm picking up on everything you're saying is that, there's really a tighter box when it comes to agency, right? And so that box it is what it is. I mean, lenders cannot go outside of whatever agency guides are, or then it becomes the non-QM type portfolio. And there's so many amazing borrowers out there who LOs are like fighting, like, can't you just make this exception? Look how much money they make. Look at their credit. They had one late, or they have this property that has, doesn't meet the guidelines, that just kind of seems super irrational. And you guys find ways to say yes to these borrowers. So I just think that there's so much more opportunity outside of that box. And I think many LOs think, it's just so tight, probably not going to fit it. They're trying to fit that square peg into the round hole too often. They should just move on, right? And like look at other types of lending options like Newfi has with these. And just at the end of the day, call the AE, right? Go through it. You guys know how to qualify these borrowers and ask the right questions. Think of ways that the LO may not. They might be overthinking it, right? And going one path, and like your AE can say, hey, no, wait, we've got 1099 income. Let's go a different route. And that's what you guys are able to do as experts. So thank you for sharing everything today.
So John, I'm going to ask you this question. I know we are over time. How come your Pinnacle GPM program has a higher rate, but showing lower payment? So what's the magic behind that?
Yes, it's definitely not magic. It's just math. It's very, very complicated math, but it's math that makes sense. And the way you do it is so this is a fixed rate loan. As for some of you who have been in the business for a long time, you may know this as an option arm. Option arms back in the day had much lower payments, and what you would do is you would make a payment that was below your interest only payment, and it was very complicated. The rate adjusted, the amount of negative amortization and deferred interest that you had on the loan was very, very high. This is a better option because it's a fixed rate loan, so your rate never changes, and but your payment does. So what happens is during the first 5 years of the loan, your payment is lower. Matter of fact, in this example, if you look at the $58.95 payment versus the Sequoia top line payment of $6,800, that had a rate of 6 3/4. The actual effective rate on the Pinnacles program is probably closer to 5 1/4, maybe 5 3/8. That first year payment drops way down. Second year, that payment goes up 5%, so $58.95 plus 5%. That's your new payment in year 2. Year 3, it goes up 5% up to year 6, where year 6 it evens out. And what happens is you do have a little bit of deferred interest in those first 5 years. We calculate it at about 3% of the total balance. but we think this is a brilliant loan. Matter of fact, Adam, it might have worked for your 2-1 buy down borrower. If you think rates are going to come down, and then there's no prepay on these loans. It's an owner-occupied transaction. The borrower is basically going to borrow from themselves with their future equity to get lower payments today. It's a brilliant loan in this environment with higher rates. And again, it gives you that option to kind of drive down rates, drive down payment to a lower level for borrowers to qualify. And again, it gets them into that more comfortable situation where they don't have to make that $6,800 payment every month for the first year. They can make a much lower payment. In this case, it's almost $1,000 of savings. And what we've calculated, we've got a cool Excel spreadsheet that'll do this for you. We actually think that over time, that the savings in the payment is actually more than the deferred interest that you accumulate during the first 3 years of the transaction. So we can take you through that math. Makes a lot of sense, but we think this is an incredible loan, especially for people that are buying new houses or have a seller that's willing to spend some money on a buy down. This is like a 2-1 buy down where you're paying for it yourself with your future equity. It's an incredible program. Thanks for pointing that out, Harish.
I think one thing too with that program is that it's just another option for people. Like, look at that monthly payment. That's like kind of like your minimum to make. Think of that as an option. You want to make the regular payment, you can make the regular payment if you want. It's going to cut down on the deferred interest in the future. But really, it's a perfect product for anyone that wants an option to have. Let's say times are tough 1 month or 2 months. Let's say they own a landscaping business in Central Illinois, and they only have there's 2 months where the income's not there. I mean, look at this program. You have those options available to you as like a monthly payment, just to kind of fall back on if needed.
All right, so here is the contact information for John and Newfi. We have a barcode, so if you guys want to kind of scan that. This webinar has been recorded, and recording will be available in a few days on ARIVE's YouTube channel. So, it will have the permanent memory there. But again, I want to thank everyone who took time to join today. Thank you, Newfi Wholesale. Thank you, Adam, for taking time to educate our audience today. Thank you so much.
Thank you.
Thanks, everybody.